Welcome, everyone. Today we are going to explore something really exciting. We are going to break down how to use the periodic volume profile in RTrader Pro. Have you ever wondered how to better understand market activity over different periods of time? If so, you are in the right place. By the end of today, you will not only understand what the periodic volume profile is, but also how to set it up and use it to improve your trading strategy. Have you ever wondered how you can gain a deeper insight into market activity by focusing on specific time frames instead of just looking at the big picture? Imagine being able to pinpoint exactly where the most volume traded at different price levels for not just the whole session, but for each day, week, or even month. This is exactly what the periodic volume profile allows you to do. It helps you uncover where the most trading activity took place over these different periods, and this is incredibly helpful for identifying potential support and resistance levels. Unlike a traditional volume profile that provides data for the entire session, the periodic volume profile breaks this down into smaller segments, giving you an even more detailed view of the market. This detailed breakdown helps you identify various chart patterns, such as double tops, flags, or head and shoulders, and understand how these patterns interact with the volume profile to provide actionable trading insights. For example, head and shoulders patterns are a reliable signal, often seen within the volume profile. This pattern typically signals a reversal after a trend, and when it forms near a significant high volume area, it suggests that the market might change direction. The head and shoulders pattern has three peaks. The middle peak, the head, is the highest, and the two side peaks, the shoulders, are lower. A break below the neckline, often accompanied by increased volume, signals a bearish reversal. Conversely, an inverse head and shoulders pattern forms at the end of a downtrend, indicating a potential upward reversal. Double tops and double bottoms are also key reversal patterns. A double top forms when the price reaches a resistance level twice, but fails to break through, indicating that the buying pressure is fading. The volume profile can confirm this pattern by showing high concentration at the resistance level. A double bottom, meanwhile, forms when the price tests a support level twice, suggesting that the level is holding and a bullish reversal may occur. High volume at these levels strengthens the case for a reversal. Continuation patterns such as flags, pennants, and triangles are also identifiable within the volume profile. For instance, a flag pattern occurs after a sharp price movement and is characterized by a small channel against the trend direction. Volume typically decreases during the flag formation and spikes upon breakout, confirming the trend continuation. Similarly, ascending triangles, where the price makes higher lows and hits resistance, often lead to bullish breakouts, confirmed by increasing volume near the resistance level. Wedges, both rising and falling, are other significant chart patterns to observe. A rising wedge during an uptrend can signal a bearish reversal, especially if the volume diminishes as the price narrows. A falling wedge, on the other hand, during a downtrend may indicate a bullish reversal, particularly if accompanied by a volume surge during the breakout. Identifying these patterns in conjunction with the volume profile provides valuable insights into market sentiment and future price movements, enhancing your ability to make well-timed trading decisions. For instance, you might notice consolidation patterns where the volume is spread across a narrow price range. This often indicates that the market is in a phase of indecision, which could precede a breakout or breakdown. Another common pattern to look for is a volume cluster forming at certain price levels. When the market revisits these levels, they often act as strong areas of support or resistance. Additionally, you might spot head and shoulders patterns, double tops, or double bottoms within the volume profile over different periods, providing early indications of potential reversals. Recognizing these patterns can significantly improve your timing when entering or exiting trades. The periodic volume profile also helps you spot trend continuation patterns, like flags and pennants, where volume diminishes during the consolidation phase and then spikes during the breakout. Understanding these patterns gives you an advantage, as they can signal when a trend is likely to resume. Can you see how these chart patterns, combined with the periodic volume profile, might make your trading decisions more informed and effective? Let us jump into how you can set up the periodic volume profile in RTrader Pro. Start by opening up your RTrader Pro platform. Once you are inside, look for the section labeled Indicators. You should be able to find an option called Volume Profile. Select this option and make sure to pick the one called Periodic. It is important that you select this version because it is what allows you to view volume data for smaller time frames like daily, weekly, or monthly. You get to choose what works best for your trading style. Do you tend to focus more on daily activity, or do you prefer to look at weekly or monthly trends? Once you have it set up, you will notice that there are bars along the price axis. These bars show you where the most trading volume happened during each of the time periods you selected. The longer the bar, the higher the trading activity at that price. There are a couple of key areas to focus on when you look at the profile. One of these areas is called the point of control. The point of control is the price level with the highest volume for that specific time period, and it often acts as a very strong support or resistance zone. Another important area is what we call the value area. The value area is the range where 70% of the trading volume took place. This is essential to watch because prices tend to move towards this area, and it can give you a better sense of where the price might be headed next. Additionally, you may notice various chart patterns forming within the volume profile that can help you understand the market behavior even better. For example, if you see a volume cluster forming at a specific level and this level is revisited multiple times, it may indicate a double bottom or double top. These patterns can be strong signals of potential trend reversals. Another pattern to look for is the head and shoulders formation. When you see the volume profile showing peaks and a higher middle peak, the head with lower peaks on either side the shoulders, this is often a sign of a reversal in trend. Spotting these types of patterns early can give you a significant edge in anticipating market movements. You can also use the periodic volume profile to identify continuation patterns such as ascending or descending triangles. If you see volume declining as the price consolidates within a triangle pattern, followed by a breakout with a volume surge, it can signal the continuation of the previous trend. Likewise, flags and pennants are continuation patterns where volume typically contracts during the flag or pennant formation and then expands during the breakout, confirming the trend direction. Recognizing these chart patterns within the volume profile is a skill that can take your trading to the next level. Volume spikes are another critical element to observe. When there is a sudden surge in volume at certain price levels, it often marks a key turning point or the beginning of a significant move. For instance, when you see a sharp increase in volume coinciding with a price breakout from a consolidation pattern, this suggests strong conviction behind the price movement, making it more likely that the trend will continue. It is important to keep an eye out for these volume spikes, as they can provide confirmation for the patterns you are seeing and improve the accuracy of your trades. Let us talk a bit more about how to use the periodic volume profile to find support and resistance levels. Imagine the price is moving towards an area where you have previously seen a lot of trading volume. This is likely going to act as a support level because there is buying interest at that price. On the other hand, if the price is approaching a level with significant trading volume, but from the opposite direction, this could act as a resistance level since there may be strong selling pressure. If you see that a stock tends to trade heavily around a certain price, you can expect that level to play an important role in the future. Have you seen this happen in your own trading, where certain price levels seem to matter more than others? To get even more from the periodic volume profile, it is helpful to combine it with other indicators. For instance, let us say you are also using a moving average. If you see the price move near a high volume area and cross a moving average at the same time, this could be a strong signal of what might happen next. Moving averages are great for identifying the overall direction of the trend, and when combined with the volume profile, they can provide better context for potential entry and exit points. Another great indicator to pair with the volume profile is the Relative Strength Index, or RSI. RSI helps identify whether a stock is overbought or oversold. When the RSI is in an overbought condition and the price is near a high volume resistance level, it could be a signal that the price might reverse. Similarly, if the RSI shows an oversold condition and the price is near a high volume support level, this might present a buying opportunity. Using RSI alongside the volume profile helps confirm potential trading setups, reducing the likelihood of false signals. You can also use Bollinger Bands in combination with the volume profile. Bollinger Bands help identify periods of high or low volatility in the market. When price approaches a high volume area and also touches the outer Bollinger Band, it can signal an overextension, increasing the probability of a pullback or reversal. Volume combined with volatility indicators like Bollinger Bands can help pinpoint the exact moments when price action is likely to change direction. Fibonacci retracement levels are another powerful tool to use with the volume profile. When you see a price retracement to a Fibonacci level that also coincides with a high volume area, it often strengthens the case for a reversal or bounce. The convergence of these two tools, volume profile and Fibonacci, can provide strong indications of market reactions at specific price levels. Stochastic oscillators are yet another complementary indicator. The stochastic oscillator measures the momentum of price. When you see that the stochastic indicator is in overbought or oversold territory and the price reaches a significant volume cluster, this can indicate a potential reversal point. Combining these oscillators with volume information helps refine your entries and exits. Remember, combining multiple indicators should be done carefully. It is important not to overwhelm yourself with too many signals. Instead, focus on 2 or 3 key indicators that work well together and complement the periodic volume profile. This way, you will gain a clearer picture of market behavior and be able to make more informed trading decisions. What indicators do you typically use when you are trading? And have you tried combining them with volume analysis for better accuracy? The periodic volume profile is not just for one kind of trader. Day traders might use it to find key levels within each daily session, while swing traders may find the weekly or monthly profiles more useful. Day traders can look at where the most volume occurred the previous day to guide their trades in the current session. Meanwhile, swing traders can use the volume profile from several weeks back to identify critical levels. For example, if you are planning a trade that will last a few days, understanding which levels saw the most trading volume in the previous weeks can help you decide when to enter or exit the market. Another important aspect of trading with volume profiles is recognizing volume spikes. A volume spike often happens at a major turning point. It means there has been a sudden increase in the amount of trading, which could indicate that a trend is changing. For instance, if a stock has been rising steadily and suddenly has a large drop in price with a high volume spike, it might be a sign that the trend is reversing. Have you ever seen a price change dramatically with a big increase in volume? It is usually an indicator worth watching. There are also some mistakes to avoid when using the periodic volume profile. One common mistake is putting too much focus on the volume data from just one period. Instead, it is better to look across multiple periods to get a fuller picture of the market activity. You do not want to be caught by surprise because you only looked at one narrow time frame. Another mistake is ignoring the actual price action while relying too much on the volume profile. The volume profile is a powerful tool, but it works best when used alongside price action. Price action tells you what is happening with the price, and the volume profile tells you how many traders are interested at certain levels. You need both pieces of information to make informed decisions. Another mistake is neglecting the importance of chart patterns that form in conjunction with volume clusters. Patterns like head and shoulders, double tops, double bottoms, ascending and descending triangles, and flags or pennants all give important clues about market direction. For instance, if you see a head and shoulders pattern forming near a high volume area, it can be a strong indication of an impending reversal. Similarly, if you see a double bottom forming near a significant volume support zone, this can indicate that the price is likely to bounce upwards. Ignoring these patterns means missing out on key trading opportunities. It is also a mistake to not recognize the significance of volume divergence. Volume divergence occurs when the price is making new highs or lows, but the volume profile shows diminishing interest at these levels. This divergence often signals that the current trend is weakening and a reversal could be imminent. For example, if the price is climbing but the volume at each successive high is decreasing, it may indicate that the buying pressure is fading, increasing the likelihood of a price reversal. Finally, another common mistake is not paying attention to the point of control shifts over time. The point of control, or POC, is the price level with the highest traded volume and can move as market conditions change. Watching how the POC shifts can give you valuable insights into where market participants are concentrating their trades. A shift in the POC can indicate that sentiment is changing, which might require an adjustment in your trading strategy. Keeping an eye on these shifts can help you stay ahead of the curve and better predict potential moves in the market. If you are having trouble with the volume profile, one of the reasons could be incorrect settings. Our Trader Pro lets you customize the profile to fit your needs. You can change the colors and sizes to make the chart more readable, and you can also filter out areas with very low volume if they are too noisy. Make sure you are adjusting these settings to match your trading style. A day trader might prefer a much shorter period, while someone who is trading for the long term might want to look at longer time frames. Have you tried experimenting with different settings to see what works best for you? To bring everything together, the periodic volume profile is a very effective tool to help you identify key price levels based on trading activity. Whether you are a day trader looking for quick opportunities or a swing trader focusing on larger trends, this tool can help you see support and resistance levels clearly and make more informed decisions. Additionally, understanding the various chart patterns that can form within the volume profile will give you an even greater edge in your trading. For example, head and shoulders patterns are some of the most reliable reversal signals in trading. When you notice this pattern forming near a significant high volume area, it often indicates that the prevailing trend is losing strength and a reversal is likely to occur. The head and shoulders pattern is characterized by three peaks, where the middle peak, the head, is the highest, and the two side peaks, the shoulders, are lower. The neckline of this pattern often coincides with key volume levels, and when the price breaks below the neckline, it is a strong indication of a bearish reversal. Similarly, the inverse head and shoulders pattern is a bullish reversal signal. This occurs after a downtrend and signifies that the selling pressure is weakening and a potential upward move is likely. Spotting these patterns within the volume profile, especially around major volume clusters, can provide you with powerful trading signals. Double tops and double bottoms are also critical reversal patterns. A double top forms when the price reaches a resistance level twice, failing to break through. The volume profile can help confirm this pattern if it shows a high concentration of trading activity at the resistance level, suggesting strong selling pressure. A double bottom, on the other hand, is formed when the price tests a support level twice, indicating that the level is holding, and a reversal to the upside may occur. High volume at these levels strengthens the validity of these patterns and provides confidence in taking positions based on them. Continuation patterns such as flags, pennants, and triangles can also be identified within the volume profile. For instance, when a flag pattern forms during a trend, volume tends to decrease during the flag's formation and then sharply increases when the price breaks out in the direction of the original trend. A flag is typically characterized by a small, downward sloping channel after a strong price movement, and the breakout from this pattern is usually accompanied by a volume spike. Recognizing these continuation patterns in real time can help you join a trend with greater confidence. Ascending and descending triangles are additional patterns to watch for. An ascending triangle forms when the price makes higher lows but encounters resistance at a specific level, creating a flat top. The volume profile can help confirm this pattern by showing increasing volume near the resistance level before a breakout. A descending triangle is the opposite, with lower highs and support at a flat bottom, often signaling a bearish breakout. Spotting these formations in the volume profile provides confirmation for potential breakouts or breakdowns. Wedges are another type of chart pattern that can be found using the periodic volume profile. Rising and falling wedges are often indicative of a potential reversal or continuation depending on their positioning in the overall trend. A rising wedge during an uptrend can signal a reversal, especially if volume diminishes as the wedge narrows. Conversely, a falling wedge during a downtrend might indicate an upcoming bullish reversal, especially if accompanied by a volume spike during the breakout. Volume spikes at key levels are often telltale signs of trend exhaustion or the beginning of a strong move. When you see a volume spike occurring alongside the formation of a pattern, such as a triangle or wedge, this is usually a strong indication that a significant price movement is about to occur. Paying attention to volume spikes when combined with chart patterns can greatly increase the probability of successful trades. Remember, the more you practice using the periodic volume profile and identifying these chart patterns, the better you will become at spotting those critical price levels and understanding the bigger picture. By mastering these patterns and understanding how they interact with volume, you will be able to enhance your trading strategy and improve your timing for entries and exits. So now that you have learned about setting up and using the periodic volume profile, take some time to try it out in your own trading. Look at the volume levels, identify the point of control, and see how the value area can guide you. Take note of the levels where the price keeps coming back, and see if you can use that information to make better trades. Feel free to share your experiences and thoughts, and happy trading to all of you.